Good morning, ladies and gentlemen. Welcome to our HHQ webinar. We hope you enjoyed our firm's introductory video earlier. Our firm, Halim Hong & Quek, was established 20 years ago, and we embrace the core values of speed, quality, and integrity. My name is Calvin Koy. Before we kickstart today's session, kindly be informed that all participants will be muted to ensure maximum hearing of our speaker today. And please feel free to use the chat box in Zoom to ask your questions away, should you have any, and we will discuss them shortly during the Q&A session. We are glad to have many esteemed attendees with us today on today's topic, essential aspects of loan financing. And I'm pleased to introduce our speaker today, Ms. Siang. Siang is a partner of the Corporate and Finance Department in Halim Hong & Quek, and her area of practice are corporate banking and corporate and commercial. Siang mainly specializes in the area of corporate banking, advising various banks or financial institutions in a broad range of legal issues on loan documentations, security documents, requirements, procedures, and compliance matters. Please join me in welcoming our speaker, Ms. Siang.
Hello, hi, good morning everyone. I'm Siang. I hope you are well today. I'll be sharing with you guys today on the essential aspects of loan financing in Malaysia. These are some of the key points that I'm going to discuss in my webinar today. Firstly, on the important provisions in the loan financing documents, financial restructuring and financial assistance provided by the government in light of the impact of COVID-19 pandemic. There are various types of loan financing available in Malaysia. The most common one would be the housing loan when you are buying a property, a hire purchase when you are buying a car, a personal loan or personal funds offered by the banks, and then commercial loan, SME loan, business loan, and corporate loan. For today's focus, I'll be discussing about housing loan as well as the commercial, SME, and business loan. Because hire purchase loan is relatively direct. When you have your desired car, you will just get the loan from the bank, and you will sign the hire purchase agreement with the bank's officer directly. And personal loan is even simple. Some of the personal loan is even without collateral, as you will be receiving calls day by day when the banks are offering you the personal loan. So for these two parts, we don't really need a lawyer. For the corporate financing, it will usually be the bigger loan amount, like construction loan, bridging loan. And those agreements need to be crafted out by the lawyers, and the documents is not a standard documents. So for today's focus, I'll be mainly on the housing loan and the commercial and business loans. These are the principal loan financing documents when we got a loan from the bank. So when the loan has been approved by the bank, the bank will issue a letter of offer. The letter of offer will stipulate all the terms and conditions and all the salient terms like your facility, amount, your tenure, your interest will all in your letter of offer. You'll need to look through thoroughly all the terms and conditions in the letter of offer. And if the terms and conditions are acceptable by you, then you will accept the terms and conditions, the letter of offer, by signing the acceptance form in the letter of offer. And thereafter, the bank will give you a list of the panel list from the bank that you will choose your desired lawyer or the lawyers that you are trusted to prepare the facility agreements and all other collateral security documents. The collateral security documents are those supporting documents. If you are buying a house, it will definitely have a land charge, the property charge. And then other than that, you may have an assignment of proceeds, the rental proceeds. For company, you might have a debenture, and in some of the loan financing, the loan might be secured by a guarantee. It can be a personal guarantee or a corporate guarantee. The next part will be, I'll be sharing with you some of the important provisions in the loan financing documents. When it comes to borrowing from the banks, a lot of time when you go to a law firm, the lawyers is telling you there is a standard documents. These are all the standard banks documents. In fact, for the facility agreement in respect of the housing loan and most of the commercial and SME loan, the facility agreement are the standard documents because it has been crafted by the bank's specialists. The banks as a panel solicitors, they have crafted a complete and comprehensive facility agreements. So that is important when you need to look into your letter offer, because letter offer will stipulate all the important terms and conditions that you need to know. Yeah, so I will highlight to you some of the important things that you need to take note in your letter or offer. The first thing will be the facility approved. This is the approved limit, your facility amount. And then the purpose of the facilities, whether you are using the facilities for the purposes of buying a house or for your working capital, for other purposes, is clearly stated in your letter or offer. Then you have a pricing, margin, interest. In Malaysia, right now we are using the base rate. Yeah, back in year 2015, if I'm not mistaken, we are using the base lending rate. But right now, all the retail loans, we are using the BR, the base rate. And some of the commercial and corporate transactions, they are using the cost of funds. And then you need to look into the tenure, the repayment terms. The tenure and the repayment terms will be your monthly installment amount, the repayment period, numbers of years, and importantly is the payment date, the monthly installment date that you need to service your loan. And if you are buying a house, do take note of the details of the property. For the security, these two parts. For the principal instruments that we are talking about will be the facility agreement. So do take note that letter offer is very important, because if you look into your facility agreement, there is a clause saying that letter offer shall be deemed to form part of and be read and construed with this facility agreement as if they were one documents. So usually the letter offer will stipulate, because letter offer is customized for every single customer. So the letter offer shall be annexed at the back of the facility agreement, and it is part of the facility agreement. And other subsidiary instruments will be the supporting instruments. That will be your property charge, land charge, your rental assignment, your guarantee or debenture. Other things to take note is that when you look into your letter or offer, there is a sections called additional or specific terms and conditions. In a specific terms and conditions, there might have a lock-in period. For conventional loan, there is a lock-in period or early settlement fee, meaning to say, if you settle your loan within the first 3 years, there is a percentage of the approved loan amount that you need to pay to the bank if you have settled earlier, but there is no such imposition in the Islamic loan. And there are other specific terms and conditions. They are like standing instructions. The bank may ask you to have a standing instructions so that your monthly installment will be deducted automatically from your accounts. And also insurance, MRTA, MLTA, or any other insurance, fire insurance, they are required by the bank. Representations and warranties, this is quite common. The bank will require borrowers to provide a representations and warranties as if the borrower, the guarantor, the security parties, they are all eligible, they have full capacity in entering the agreements. And also all other warranties and representations, there is no act of bankruptcy, they have not commit any litigation, no bankruptcy proceedings. Those are quite general and standard representations and warranties available in all banking documents. Variation of interest rate. When it comes to interest rate, as we know, the interest rates has been prescribed in the letter of offer. But if you look into the BR, the base rate will be prescribed by the bank from time to time with the guidelines from the bank issued by the Bank Negara Malaysia. So your base rate will be changes from time to time. That's why when it comes to a variation of interest rate, the bank will usually give a notice to notify you on the changes. When there are changes to the interest rate, it will directly affect your monthly installment and the amount that you're going to service. So this is very pertinent. The next part I'll look into the overdue or default interest. when the loan repayment, when usually under our letter offer, we will know by when, maybe by 7th day of the month, we need to service our loan. When you did not service your loan punctually or when the loan is overdue, I put a 1 to 3 months because it depends on the terms stated in your letter offer. It depends on the bank's practice. The interest will be automatically increased to a higher increase pricing or interest. Why you say so? I'll show you an example. Yeah. This is a scenario which I'm taken from one of the letter offered by the local bank in Malaysia. So if I have a loan amount of 1 million, my interest rate stated in the letter offer is BR plus 0.7% per annum. So BR here refers to the bank's base rate. It is subject to changes prescribed by the bank from time to time. So currently the BR rate is 2.27% per annum. So meaning to say my interest rate is a BR plus 0.7%. If you look into here, BR plus 0.7%, which is equal to the current BR rate 2.27 plus 0.7%. So my interest rate in my loan, 1 million loan, is 2.97% per annum. You will find a default clause somewhere in your letter offer. So the default clause will basically stipulate that when the repayment is overdue or in default, the interest will be automatically increased to certain numbers of percentage plus the BR rate. So I'm taking one of the example in one of the conventional bank's letter offer. Here it stipulates 3.2% plus the BR rate or 1% above the prevailing interest rate on the entire outstanding amount, whichever is higher. I do simple calculations here. The default interest would changes because if you put in 3.2% plus a BR rate, it becomes 3.2% plus a 2.27%. So the default interest rates will jump to 5.47% per annum, or 1% above the prevailing interest rate. So it will be 1% plus my current rate, which will be 3.97% per annum, whichever is higher. So if you've taken a higher one, initially, if I am servicing my loan punctually without delay, my rate is only 2.27, which is very 2.97, which is very low. But if I am defaulting or I'm late in making my repayment of loan, it will jump to a default interest for 5.47%. That is pertinent because the jump is substantial. And how do we get back to the normal rate? And how can the bank revert back to the normal rate? If I look into one of the bank's letter offer, which is very good letter offer, because it clearly stipulates that subject to the terms and conditions of the letter offer, the interest rate will be reverted to the previous prevailing interest rate, meaning it will revert to your normal rate the following month upon full regularization of the loan during the bank's quarterly review. So sometimes certain banks, they will do quarterly review every 3 months. So if you regularize your payment for the next 3 months, your rates will automatically be adjusted to your normal 2.97% per annum rate. But this is not it. I wouldn't say that it is applicable to all banks, so you need to refer back to your letter offer. I always urge everyone, if there is any delay in payment, if you forget to make a payment punctually based on the due date, it is always good to give the banks a call to notify the banks that for this month you have been delayed, for the next month and the following months that you have been serving your loan punctually, so you will request the bank to revert it into the original rate. That's why notice is important. Whenever there's any changes to the rates, whenever there is any default rates, the banks are issuing notice. So I heard many are saying that I didn't receive any notice from the bank. I don't know anything. The bank has not given me any notice. In fact, from now on, the bank has given all notices. Even for all variation of interest rates, the banks are giving sufficient notice. So the notice can be by way of the statements delivered to your house, or if you are doing paperless, they will be sending you to your electronic email, or I even receive SMS or for all the notifications given by the banks. And the next thing to look into in your letter offer or facility agreement will be the events of default. This is important. What amounts to an event of default? Default kicks in when there is a breach or failure to perform your rights and failure to perform things that you have promised under the agreement, or you are in breach of certain terms and conditions in the letter offer or facility agreement. The simple one would be default comes in when there is an act of bankruptcy, when there is a winding up petition against the company, or defaults can come in when there are certain things that positive covenants and negative covenants that you should do, you shouldn't do, but you are not obliged. Yeah. When the defaults came in, there will be another clause is cross default. When there is a breach for the default, then the cross default would be if you are having a multiple financing in the same bank or with the bank's subsidiary. For example, if I'm having a housing loan with public bank, if I'm defaulting in the housing loan with public bank, I may have other hire purchase or car loan with public Islamic bank. So by defaulting my housing loan in public bank, the other loans, the banks has right to recall and call for default for all my other facilities under the same bank or with all subsidiaries of the bank. So if you are defaulting in one loan, it may result in defaulting in all your loans. So this is the cross default clause. Positive covenants and negative covenants are it will usually not appeal in your housing loan letter offer. Positive covenants and negative covenants have usually appeal in commercial loan or corporate financing. Positive covenants are things that you need to do, as if you need to furnish your statements, your financial statements in accordance with the bank's timeline. You need to furnish whatever documents that you are required to furnish. And positive covenants also cover things that you need to carry on your business in a proper manner, in due diligence. And the negative covenants are things that you shouldn't do without the bank's prior consent. Negative covenants are quite general in the sense that you shouldn't make any material change to your business operation, core business. You shouldn't have any changes to your directors or shareholders without the bank's prior consent. And you shouldn't alter your share capital. You can't increase, you can't reduce your share capital without the bank's consent. So all these things are quite common and it captures in your negative covenants. And other important negative covenants is that you shouldn't give any form of guarantee to any other person without the bank's consent. And other things I can think of is if you wish to borrow or incur further indebtedness, you have to get your current bank's consent as well. So all these are captured in your agreement as well. Next one, the bank's right to commence foreclosure and legal proceedings concurrently. So for this clause, the banks has the rights to, in the event there is any default by the borrower, the banks has right to commence legal action against the borrower. At the same time, if there is a land or property charged to the banks also has right to auction the property. And simultaneously, if there is any guarantor as a security party in guarantee the loan, the banks has also have a concurrent rights to go against the guarantor. So next thing is the consolidation right to set off. Consolidations, if there are multiple banks accounts, multiple loan financing with the banks or within the bank's subsidiaries within the group, the banks has right to consolidate all the accounts, and the banks has right to set off your accounts, savings in one account against the other accounts. So conditions precedent for drawdown, these are all the preconditions that need to be fulfilled before the bank will disperse the loan. So the preconditions are those things like you need to conduct the necessary bankruptcy, such as if you are required to open an account with the bank, you have to do so. If you are required to furnish a valuation report evidencing that your market value of the property achieving the benchmark required by the bank, so you have to furnish. And yeah, you have to furnish all the contractual or risk policy, fire insurance policies, your duly paid your current assessment. All these are the preconditions before the banks can draw down the loan. Yeah, my next part will be talk about the fair treatment of financial consumer. As I said, most of the bank's facility agreements we call it standard agreements, standard contracts. But these standard contracts are not really that simply one-sided contracts. So I'm putting in this case a fair treatment of financial consumer. This is one of the federal court in the landmark case, which I did not reveal the bank's name. It was held that a financial institution can no longer rely on the exclusion clauses contained in their loan agreement to shield themselves for being sued for negligence. Following this federal court landmark case, the banks has issued a circular to all financial institutions sometime in 2019 by providing a time frame of 6 months for the financial institutions to review the terms and conditions of their loan agreement and to remove the element of unfair treatment. Unfair terms, unfair treatment. Under this policy, the title is Fair Treatment of Financial Consumer, which was issued on November 2019, which came into effect on this year, May this year. But some of the terms under the unfair contracts, which has also came into effect simultaneously on the 6th of November 2019. So these three are the salient terms in the policy itself. Financial service provider, we are referring to financial institution. Financial service provider must ensure that the terms in the standard contracts are fair to the financial consumer. The terms are regarded as unfair if it has a tendency to create a significant imbalance where it swifts the rights and obligations significantly in favor of the financial service provider to the detriment of the financial consumers. And the financial consumers are protected here under this policy, which includes SME customers and individuals. A financial service provider must not have contract terms that impose barriers which make it difficult for the financial consumer to switch to another financial products or another financial service provider before the end of the contract tenure. And it says that it has to include a clear and prominent statement to remind the financial consumers to read and understand the contract terms and to discuss with the financial service provider officers if the consumer do not fully understand the terms of the contract before signing. In short, the bank's standard contracts with now to me is a very fair contract because whatever changes that are required to be made by the bank, sufficient notice will be given. The important thing is I always urge all my customers, you have to read thoroughly your letter of offer, every single clause, to ensure that there is no misunderstanding or misperceptions when you are getting a loan from the bank. So my next, second part of my topic will be on the financial restructuring. Financial restructuring here, we are referring to rescheduling and also restructuring. Let's talk about rescheduling. Rescheduling means it is extending or lengthening the loan tenure. So it is longer period for repayment, resulting the revision of your monthly installment amount. Usually when we're lengthening or extending our loan tenure, we are paying a lesser sum each month, meaning it reduces our monthly burden, our monthly commitment, but the end result is we are ending up paying more interest because you need to service your loan for a longer period. Restructuring, on the other hand, it involves changing the type of the structure of the existing loan to help to improve your current cash flow or other significant change to its terms. So restructuring referring to a more significant changes made to the terms and conditions in your existing loan compared to rescheduling. Restructuring, it can be restructured within the same banks. It can be restructured to any other banks, and you may convert your existing facilities to other facilities, or you may consolidate your existing facilities to other types of facilities. So by doing so, it looks like it's a bigger exercise and it will incur additional administrative and legal costs on top of the usual interest charges. One of the example is you may convert your overdraft facilities into a term loan facilities, meaning from a short-term facility to a long-term facilities which attracts a longer period for repayment. For both rescheduling or restructuring of loan, the borrower will be required to execute an instrument to reflect the rescheduling and restructuring exercise. If there is an additional loan sum, the borrower will require to execute further documents or facility agreement or any other security documents required by the bank, in which, in that sense, additional loan sum will be subject to additional stamp duty imposed by the government. In general, the banks favor restructuring or rescheduling as a form of aid for customer because it improves the bank's resilience by reducing non-performing facility portfolios as well as maximize the credit recovery. As you can see, Malaysia government has announced its economic stimulus package 2020 sometime early this year, wherein one of the measures introduced to provide an exemption of stamp duty for rescheduling and restructuring of loan for agreements entered between borrowers and the financial institutions for the purposes of rescheduling and restructuring of business loan. This exemption is applicable if the stamp duty on the original document has been paid and the agreement has to be executed for the period from 1st of March 2020 until end of the year. For your information, stamp duty chargeable by under the Stamp Act is 0.5% on the loan amount for the loan transaction. So the stamp duty exemption, actually there are various stamp duty exemptions given by the government from time to time. If you look into this chart, this is one of the schedule done by our firm pertaining to the stamp duty remission and exemption. But if you look into here, the top column, if you look into the loan part, this is applicable to the first-time home buyer, whereby if the property value is between 300,000 to 500,000, there is a remission, a deduction of 1,500 if you are purchasing for the loan stamp duty if you are purchasing a residential property. But the residential property are excluding all these SOBO, and service apartment. And also, if you are first-time home buyer, the property purchase is less than 300,000. It is a residential property. You are fully exempted from stamp duty. Malaysia has also introduced a HOC, the National Home Ownership Campaign. This is applicable for the property value between 300,000 to 2.5 million. The stamp duty is also exempted, but this is subject to if you are direct purchase the residential property from the developer, and that developer and the project itself that has participated in the government announced HOC campaign. Other columns are in respect of the transfer for the stamp duty for transfer. So yeah, this is also another chart done by us. Yeah, the same thing, the PUA 217, the same thing is for the purchase of residential property from with the developer. And it has to be a residential property for the value between 300,000 to 2.5 million. And the preconditions is the project has to be registered with the HOC campaign, the home ownership campaign. So the purchases will enjoy 100% stamp duty exemption. Last part of my topics will be the financial assistance provided by the government in light of COVID-19 pandemic. The government has announced a 6-month moratorium for loan financing repayment starting from the 1st of April, which is ended on September 2020, to help to relieve the monthly burden of individuals and businesses whose income has been affected by the pandemic. With the transitions to the targeted loan repayment assistance TRA, beginning of the 1st of October 2020, the bank has continued to offer extended moratorium and other forms of repayment assistance. So according to Budget 2021, to date, more than 650,000 applications for repayment assistance has been received by the government with a high approval rate of 98%. The banking industry and the government are strive to provide a targeted moratorium extensions and the provisions of the repayment flexibilities as follows. For individuals who have lost their jobs in 2020 and have yet to find a job will be offered an extension of loan moratorium for a further 3 months by their respective banks. Individuals who are still in employment but whose salary has been affected due to COVID-19 will also be offered a reduction in the loan installments in proportion to their salary deduction, depending on the type of loan financing. For car loan hire purchase financing, affected borrowers will be offered a revised installment schedules that are consistent with the Hire Purchase Act 1967. In addition, the banks has also provide repayment flexibilities to the SME borrowers who financially affected by COVID-19, taking into account of the specific circumstances of the borrowers. Some of the measures taken that allowing the borrowers to pay only interest portion over the loan interest portion of the loan over the period of time, and lengthening the overall period for the repayment of loan, which resulted reduce of their monthly commitment. So, and also other forms of flexibility until the borrower is more stable to resume their repayments in full. To get all these flexibilities, the Bank Negara has in fact issued all guidelines to the financial institutions to have a very simplified applications and documentation process to ease all the borrowers. The flexibilities provided by the government to the borrower during this period will not appear in the secret report of the borrower, so it does not affect any credit report or credit risk of the borrower. The government has also have this body, I believe most of you have heard about it. This concern individuals and SME. Government has an agency counseling dan pengurusan kredit. In short, we call it AKPK. It is an agency established by Bank Negara Malaysia to provide advisory services and assistance to individual borrowers and also SME in managing their finances through the provisions of counseling and advice on financial management, debt management program to assist consumer to regain financial control, and financial education on the responsible use of money and credit management skills. Yep. Those earlier slides are all the existing measures taken by the Bank Negara Malaysia. So the next one will be the new applications, the new facilities announced under the budget 2021. These are all the additional measures taken by Bank Negara Malaysia and government to enhance the existing facilities to provide relief and support for the recovery of SME. So there are targeted relief and recovery facility, high-tech facility, micro enterprises facility. The Targeted Relief and Recovery Facility, TRRF, is a 2 billion facility for eligible SME whose revenue has been affected by the recent recovery and conditional MCO. The SME in targeted vulnerable sectors are personal services, food and beverages services, human health and social arts, entertainment, recreational subsectors are eligible to apply for this TRRF. It is offered at a concessionary rate out to 3.5% and will be available through the participating financial institutions. This facility will only be open for applications starting from 1st of December 2020. Next one is a high-tech facility. This is a 500 million facility to support SME in the high-tech sectors, fertilizers, synthetic rubber, basic chemicals, refined petroleum products, biotech pharmaceuticals, as well as air and spacecraft subsectors. This HTF aims to sustain Malaysia a competitive positioning in the global value chains and safeguard high-skilled jobs. The HTF will be announced on the 1st of December 2020. Another measures is the micro enterprises facility. The facility will be increased from the existing 300 million to 410 million to support micro enterprises, including gig workers on digital platforms and self-employed. This is to assist those temporary workers, independent contractors, freelancers. They were eligible to apply for these MDF facilities. The facility is for working capital and capital expenditures. These are all additional measures taken by the Bank Negara to ease the burden of financial concerns faced by most of the SME. So those are to be applied after 1st of December 2020 onwards. Yeah, that's the end of my sharing sessions.
Thank you, Ms. Teo Siang Lee, for the enlightening sharing session. I'm sure it has helped us to better understanding of the essential aspects of the loan financing. To recap, she has shared on the important provisions in the loan financing documents. Secondly, on the financial restructuring. And thirdly, on financial assistance provided by the government in light of the impact of COVID-19. Now we will come to our Q&A session for this webinar. We have a couple of questions from the Zoom chat. I'll start with the first from Raymond Liu. So Raymond has asked, for the interest rate to be reverted to its original rate of 2.97% per annum, must the past default payments be made good first?
The answer is yes. All the past payment has to be made good first before you have to regularize your payment. So you have to service your payment punctually and you have to make good first. Unless you do a restructuring when the banks agree with other schedule or other arrangement, otherwise you have to make good all the past due payments and you have to serve your payments punctually for the next few months and the bank will revert it into the original interest rate.
Second, we also have a question from Edwin Sen. He have asked where debentures have negative covenants, is there a need to register this as a charge with SSM?
Debentures have a negative covenants. I think, How can a debenture have a negative covenant? You mean there is a negative covenant stipulated that you can't create a debentures without the bank's prior consent in it? The second part of the question, debenture has to be registered with CCM. It is a statement of particulars to be lodged with charge under Section 352 of the Companies Act. If you are creating a debentures, it has to lodge with CCM. Yeah, so that's one, is a statutory law. Secondly, whether if it is a negative covenants, you can't create a debentures without your existing financier's consent. You have to get a consent first before you can create your debenture. I hope I answered your questions. Yeah.
Thank you, Siang Lee. We have one question from YC Leong, where he posted to us. So for benefit of everyone, we would type it out in the chat box. He asked, what actually happened in loan restructuring?
Cannot see. Let me see the.
Generally, what are the pros and cons to the purchaser or buyer when he chooses loan restructuring?
Pros and cons. Pros and cons when choosing restructuring. Pros and cons depending on what is your needs. What is the purpose of doing restructuring? When you are doing restructurings, it comes to my mind, what is the point, what is the purpose of doing restructuring? What do you intend to achieve? If you want to do a rescheduling or restructuring, because I want to reduce my monthly installments, then you can do it rescheduling. You can lengthen your overall repayment period. At the same time, it will reduce your monthly commitment. If you talk about restructuring, if you have been offered a competitive interest rate and you don't have an issue in repay your loan, I don't see a need to do restructuring. Unless you are doing restructuring for the purpose of getting additional loan, or you want to combine a few facilities or consolidate a few facilities into one, or you have other purpose, then you can think of to do a restructuring that suits your financial needs. If you talk about cons, if you are doing restructurings, of course, there will be additional documents required to be prepared, as if you need to prepare additional facility agreements. The bank may also ask you to provide further security. You may need to charge your current property to the bank. That, in other sense, you will incur legal fees in the preparation of documents. If you are getting additional loan, then there will be a stamp duty imposed on the part of the additional loan. So restructuring depending on your needs, depending on what exactly suits you. Yeah.
Thank you, Siang Li. We have another question from YC Leong. It's also for the benefit of all, we have typed it into the Zoom chat. He has asked, since I signed the loan agreement in year 2019, the loan rate is fixed at percent plus BR. The BNM already revised OPR or BR rate for 5 times. But the bank also shared me they revised the BR as per the image every time. However, until now, they only revise my loan rate, which equals to the loan amount for 2 times. What can I do?
I'm looking at it.
Okay.
I'm looking at the image. BR rate, base rate is 3 point something. Okay. You see, the questions here, the loan rate is fixed at how many percent plus BR? It didn't state it here. There are 2 possibilities. When the bank adjusts their OPR rate, when the bank Negara adjusts the OPR rates, it will definitely affect the BR rates. When the banks increase the OPR rates, your BR will increase. When the bank reduce the OPR rate, your BR will reduce. So the important thing is, what is the fixed rate stipulated in your facility, in your letter offer plus the BR? If the percentage stipulated in, is it stated here? 0.75% plus, 0.7% plus the BR. If let's say it's a 0.7% plus BR, the BR has been reduced. So the rate is supposed to be adjusted and revised automatically. So the loan amount for 2 times, until now, they only revise my loan rate plus the loan amount for 2 times. What does it mean? I think for this, you may want to inquire your banks, because if let's say the BR has been reduced and the rate has been clearly stated, it will be reduced automatically. It has to be adjusted automatically because it has to follow your base rate and the banks as required by as imposed by the banks. It will adjust automatically. So I would suggest you to give a call to the bank, or you can drop by the bank, to inquire about your situation.
Thank you, Siang Li. So YC Leong, I hope that answers your question. So inquiry has to be made with the particular bank. So we will still keep the questions coming. Please feel free to put your questions, if you have, into the chat box.
YC case, sorry to interject. YC case is interesting. You may want to send us an email. You can just leave your contact. I will contact you on that.
Yep. Is there any more questions from the floor? If no, I thank everyone for your questions. And before we end this session, kindly be informed that an evaluation form will be sent to all of you via email. And we look forward to your feedback on our webinar today, for our speaker and for our webinar itself, for improvement in the future. Okay, we have one question, one last minute question came from Raymond Liu. I'll read that out. Okay, he posted twice. I'll read the last one, I suppose. So Raymond asks, in budget 2021, you indicated that 650,000 applications for repayment assistance have been received with a high approval rate of 98%. Is this 98% supported? From my discussion with many SMEs, very often than not, the banks are avoiding them. Can you recommend any of your friendly banks who are more SME centric? A slight digression from the discussion, is the COVID-19 rules or law effective to protect the consumers, such as tenants defaulting in rental payments? It's a mouthful. Rental payments due to cash flow problem.
Yeah, I think. Sorry for the first part. Yeah, in the budget 2021, announced by last Friday, it is indicated that the approval rate is 98%, and friendly bank who are SME centric. I don't see many friendly banks that do in our client in our panel banks. Most of the banks that we know, they are friendly, and they are willing to assist all the SMEs in doing all the restructuring and rescheduling. So yeah, I can recommend to you, Raymond. Probably you just drop me an email on that. Yeah, I will share with you on the those friendly banks. You may approach the banks. Then the last one is the COVID-19 in it. Slight diversion from the discussion is the COVID-19 rule effectively to protect consumers such as tenants. If I'm not mistaken, with the COVID-19 rules, the tenant are actually being protected from being sued for rental payments until end of the year. So there is this protection by the tenant. But that is only applicable and where the tenant shouldn't be being sued in court, but it doesn't really protect you from not paying rental.
Yep. Thank you, Samly. So basically, I would understand it as it would just temporarily provide a contractual relief to the tenant for preventing any legal action against the tenant. Thank you, Raymond, for your question. And as mentioned earlier, we will send you a evaluation form for you guys to provide us some feedback. And with that, I believe there's no more question, and it concludes our webinar today. I wish to thank our speaker, Ms. Siang Lee, once again for the wonderful sharing. And to all of you who are with us today, stay safe and goodbye.
Thank you, everyone. Thank you for joining us these sessions. Yeah.